Imagine a company that's, well, practically printing cash.
Right.
I mean, they're bringing in over $12 billion in pure profit. They're adding millions of new subscribers globally, and their operating margins are just, they're expanding every single quarter.
Which is rare.
Yeah, very rare. Now, imagine walking onto Wall Street and seeing investors treating that exact same company like it's, going completely bankrupt.
It's the ultimate market paradox, really.
Totally.
You have this fundamental reality of a booming business that's completely detached from the sheer panic we're seeing in the stock price.
Right. Well, welcome to today's deep dive. For you listening, our mission today is to really uncover the truth behind this massive contradiction.
Yeah, we're looking at the financial and strategic landscape of Netflix, specifically for the year 2026.
Exactly. And we've got a massive stack of sources here to go through. We're working off investment thesis notes, the latest financial data, market sentiment analysis, and all the recent analyst ratings.
And what they show is pretty shocking. It's a stock that is absolutely plummeted from its all-time highs.
Plunged.
Yeah, despite a business model that honestly seems healthier than ever. So the core question we really need to answer for you today is whether this massive drop is a glaring warning sign. Is this a dying tech giant?
Right. Or is it a screaming buy, like a value stock hiding right in plain sight?
Exactly.
So I want to start by framing just how jarring this disconnect really is. Because if you just looked at the stock chart right now, you would assume the product completely failed.
Oh, yeah. You'd think a competitor ate their lunch or, I don't know, there was some massive accounting scandal.
Right. It looks like a total death spiral.
The price action is just brutal. Over the past year, Netflix shares have fallen 36.69%.
Oh, wow.
And the bleeding hasn't even stopped. I mean, in the last month alone, the stock is down another 13.38%.
That's rough.
Yeah, it's currently hovering right near its 52-week low, right around $72.88.
Right. So that's the panic on the outside. But let's look at what's happening inside the actual business.
Okay.
It's kind of like, imagine you're standing outside this wildly popular restaurant, right? The line is completely out the door, wrapping around the block.
Right.
You look over and you can see the manager just taped a new menu to the window where, all the prices just went up.
Classic.
Yeah, and the cash register inside is just ringing nonstop. But at the same time, there's a guy standing on the corner screaming at the top of his lungs that the restaurant is finished and everyone needs to run away.
That actually perfectly captures the fundamental data we're looking at here.
Right.
Yeah, because in the first quarter of this year, Netflix's revenue actually grew by 16.19% year over year.
Which is huge.
For a company of this massive global scale, maintaining double-digit top-line growth is exceptionally rare.
Yeah, it's not a startup anymore.
Exactly. And looking ahead, management is guiding for full year 2026 revenue to land somewhere between $50.7 billion and $51.7 billion.
So that implies a really robust, 12 to 14% growth rate?
Exactly.
And crucially, they aren't just buying that growth, right? They aren't slashing prices or burning cash to get there.
Not at all. That's the craziest part. Their profitability is actively expanding.
Wow.
They're targeting a 31.5% operating margin for the full year of 2026. And they're specifically guiding for a 32.6% operating margin in the upcoming second quarter.
So they're getting more profitable as they grow.
Precisely.
Okay, so to understand why the business is booming while the stock is literally crashing, we have to look at the strength of their underlying foundation, their moat.
The moat is key here.
Yeah, and what's fascinating in these sources is how they flexed that moat recently. Back in March, they pushed through a pretty significant price increase in the U.S.
Right.
They raised prices across all their tiers by an average of about 11%. Now, basic supply and demand economics tells us that when you hike prices by double digits, you're going to lose customers.
Oh, absolutely. You expect immediate churn. Any standard model plans for a certain percentage of the user base to cancel out of pure frustration.
But the data in our sources shows that year-over-year retention actually improved across all regions after that price hike.
It's wild.
Yeah. People were paying more and fewer people were leaving. I mean, how is that mechanically even possible?
Well, it comes down to incredible pricing power and really complete cultural inelasticity.
Cultural inelasticity.
Yeah, I mean, Netflix operates the world's largest paid streaming service. They have over 325 million paid memberships.
That's a massive footprint.
Right. So when a company can raise prices by 11% and retention actually improves, it proves that the consumer dependency on that content library is absolute.
Oh, I see. So the switching costs for a consumer aren't really financial anymore.
Exactly. They're behavioral. They're cultural. If you cancel, you miss out on the global water cooler conversation.
You're totally disconnected from the zeitgeist.
Yeah. They've essentially transitioned from like a luxury entertainment add-on to a household utility.
Like your water bill or electricity.
Pretty much.
But, you can only pull that lever so many times.
Yeah.
You can only raise prices so much before people truly do hit their limit and cancel. So eventually you hit a ceiling.
And they know that.
Right. And when a $50 billion tech giant hits a growth wall on its core product, they have to pivot. They have to find massive new piles of money to justify that 12 to 14% growth rate you mentioned earlier.
Which brings us to the one thing Netflix swore for years they would never, ever do.
Introduce commercials.
Exactly. The pivot to advertising.
And looking at the notes here, this isn't just a small side project anymore. It has become an absolute juggernaut for them.
The scale of the pivot is honestly staggering. The ad segment is currently on track to double.
A double.
Yeah, they're projecting it to grow from $1.5 billion in 2025 to approximately $3 billion by the end of 2026.
Wow.
And the user acquisition numbers totally support that trajectory. The ad-supported tier now represents over 60% of all new signups in the markets where it's available.
See, here's the part that I really want to dig into because the numbers are just wild.
Yeah.
It's not just the sheer volume of new ad-supported users. It's what Netflix is able to charge brands to actually reach those users.
The premiums are huge.
Yeah. The data shows they're commanding these massive premium ad rates, roughly $30 to $40 per 1,000 impressions, or what the industry calls CPM.
Right.
Why is that number so astronomically high? Like, what makes a Netflix ad worth so much more than a commercial on legacy TV or, a banner ad on a website?
It's all about the mechanism of connected television versus legacy broadcast.
Okay, explain that.
Well, think about how legacy TV advertising works. A brand buys a commercial spot during a sitcom, right? And they're just hoping that their target demographic happens to be watching at that exact moment.
So it's kind of like paying for a billboard on a highway hoping the right car drives by.
Exactly. It's an assumed very broad audience.
A total shotgun approach.
Precisely. But Netflix operates on first-party data. They know exactly who is watching, what their household profile looks like, what device they're using, and what their viewing habits are.
So it's more like a highly targeted GPS system.
Right. And furthermore, advertisers are just desperate for high-quality, brand-safe environments.
Oh, that makes sense.
Yeah, when you're watching a high-budget Netflix original, you are completely glued to the screen. The ads are unskippable, and the viewer is highly engaged.
Right.
That creates a captive audience metric that advertisers are willing to pay a massive, massive premium for.
And they're taking that premium captive audience model and applying it to live events now, too, right?
Oh, heavily.
Look at the World Baseball Classic. Our sources show that broadcasting that live event drove the largest single sign-up day in Japan's history for Netflix.
Well, because live events force urgency.
What do you mean?
A critically acclaimed television series is evergreen, right? You can watch it next month, and it still retains its value. You can put off subscribing.
Right. There's no rush.
But live sports, you have to be there right now. The outcome is happening in real time. It completely forces the consumer's hand to, pull out their credit card and sign up immediately.
Okay, but wait, hold on. I'm looking at this whole strategy commercials interrupting my shows. Bidding billions of dollars for live sports broadcasting rights.
Yeah.
This sounds incredibly familiar. Weren't they supposed to be the disruptive anti-cable company?
The disruptors, yeah.
It sounds to me like they're just reinventing Comcast. Why should investors be excited about them becoming the exact legacy media model they originally destroyed?
That is exactly the dominant narrative among the skeptics right now. And, it's a very fair observation on the surface.
Right. It looks like a step backwards.
But if we dig into the actual financial mechanics, Netflix has a massive structural advantage that legacy media simply does not have.
Okay.
It really comes down to their balance sheet and the incredible leverage of their global scale.
Break that down for us, because, legacy media companies have massive scale, too. Disney, Paramount, they're global.
They do, but legacy media is currently drowning in debt. They got decades of physical infrastructure costs, really bad past acquisitions, and this constantly declining cable bundle dragging them down.
That's true.
Our sources actually rate Netflix's financial health an 8 out of 10. They have a pristine balance sheet.
8 out of 10 is solid.
Yeah, and because they aren't overburdened by debt, they can afford to spend roughly $20 billion on organic content production this year alone.
But wait, isn't spending $20 billion on content exactly what gets legacy media into trouble in the first
The
place?
key difference is the amortization leverage.
Amortization leverage.
Yeah, think of it like a factory. A legacy cable network builds a highly expensive, bespoke car. Let's call that a new hit show.
Okay.
But they can only sell that car to a specific neighborhood of, say, 20 million cable subscribers in North America.
Right.
Netflix builds that exact same car for the exact same cost. But because they own the digital roads in 190 countries, they instantly translate it, dub it, and sell that exact same car to 325 million different driveways simultaneously.
Oh, wow.
The cost to produce the content is the same, but the distribution leverage is infinitely higher.
That's a huge difference.
And now, they're selling $40 CPM ads against it globally. The unit economics completely dwarf legacy cable.
Okay, so their ad revenue is surging, their distribution leverage is unmatched, and their subscriber base is so loyal they don't even blink at double-digit price hikes.
Right.
That leads us directly to the cash. Because Wall Street is absolutely obsessed with their free cash flow right now.
And for very good reason. Free cash flow is essentially the money a company is left over after paying for all its operating expenses, content production, and, capital expenditures.
It's the pure profit.
It's the ultimate measure of a company's true financial power.
And Netflix didn't just grow their free cash flow, it absolutely exploded. It surged 91.44% in the first quarter alone.
It's unbelievable.
And that massive leap prompted management to raise their full-year 2026 free cash flow guidance to approximately $12.5 billion.
Just think about that. That is $12.5 billion of pure unencumbered cash generated in a single 12-month period.
So if they have all this cash, what are they doing with it? And I guess, more importantly, why is Wall Street seemingly so annoyed with their corporate decisions recently?
Well, this is where we uncover a major piece of the disconnect between the stock drop and the business reality.
Okay.
Wall Street loves a flashy mega merger. Acquisitions generate massive fees for investment bankers, they create really exciting headlines, and they promise all these theoretical synergies.
Right, and there has been a massive frenzy of M&A mergers and acquisitions in the media space recently.
Tons of it.
But looking at the sources, Netflix has definitively walked away from all of it.
Right.
Like, they completely refused to engage in bidding wars for Warner Bros. Discovery.
Yep.
They walked away from Roku. There are even rumors they completely ignored Lionsgate. They're just sitting out the entire M&A frenzy.
And the market is basically throwing a tantrum. They're heavily punishing the stock because they view management as being, quote, too conservative.
But isn't that a paradox? I mean, Wall Street is selling off Netflix shares because the company isn't blowing billions of dollars on struggling legacy assets.
It is, yeah. But it's actually the brilliance of disciplined inaction.
Disciplined in action.
By refusing to overpay for legacy studios or hardware companies like Roku, Netflix is actively protecting that pristine 8 out of 10 balance sheet.
Because if they bought Warner Bros., they would instantly inherit billions in legacy debt.
Exactly. By doing nothing, they guarantee that $12.5 billion free cash flow floor remains completely safe.
Which allows them to heavily reward their own shareholders instead of, enriching investment bankers.
Precisely.
They resumed their share buyback program. And in the first quarter alone, they repurchased 13.5 million of their own shares for $1.3 billion.
It's massive.
And they still have $6.8 billion authorized for future buybacks. They're essentially saying, we think our stock is incredibly cheap right now, so we're just going to buy it ourselves.
Exactly. It's a highly rational, long-term capital allocation strategy that the short-term fee-hungry market is currently penalizing.
But wait, I have to point out a glaring contradiction in the data here.
Okay, what is it?
We just established that the corporate entity is generating record cash and buying back $1.3 billion of its own stock because management presumably thinks it's a massive value.
Right.
But if you look at the insider flow over the last 3 months, corporate insiders, like the actual human executives running the company, have sold $123.1 million worth of their own shares.
Oh, yes.
And there is absolutely zero reported buying from insiders.
Right.
If the company is such an unassailable cash printing machine, why are the executives quietly selling off their own personal shares?
It's a great catch, and honestly, whenever you see insiders selling, it naturally raises alarms.
Yeah, it looks really bad.
It does. However, we have to look at the mechanics of executive compensation to really contextualize these numbers. Yes, individual executives sold $123 million in stock, but you have to weigh that against the institutional return of capital. The corporate entity bought back $1.3 billion.
So the corporate buyback dwarfs the individual insider selling by, like, a factor of 10.
Exactly.
But still, why are the executives selling at all if the fundamental data is so strong?
Well, insiders sell for a lot of structural reasons that have absolutely nothing to do with the health of the business.
Like what?
Well, a lot of executive compensation is tied up in stock options, right?
Sure.
When those vest, executives often have to sell a portion immediately just to pay the massive tax bills associated with the income.
Oh, that makes sense.
Furthermore, it's just basic financial planning to diversify. If your salary, your bonuses, and your entire net worth are all tied up in a single company, you sell shares to buy real estate or index funds, so you aren't completely exposed to one single asset.
Right. You don't put all your eggs in one basket.
Exactly.
Yeah.
You have to follow the corporate capital. The $1.3 billion buyback is a true indicator of management's conviction.
Okay, so if it isn't the balance sheet that has the market spooked and the fundamental business model is printing cash, what is actually causing this massive 40% sell-off? Why is the stock sitting at a 4-year low of $72.88?
It comes down to a concept called multiple compression. This is really vital to understand.
Just walk us through it.
Multiple compression happens when a company's actual earnings and profits are going up, but the premium that investors are willing to pay for those earnings is actually going down.
Okay.
So Netflix is currently trading at roughly a 24 times forward price to earnings ratio, which is a 4-year low.
And looking at the sentiment analysis here, there is a very clear boogeyman causing this multiple compression.
Oh, yeah.
2 letters.
AI, artificial intelligence.
Yeah, that's the one.
The broader macro market seems absolutely terrified that AI-generated content and infinite hyper-personalized short-form video will just completely eat into Netflix's engagement time. Right. It's the market pricing in the fear of infinite supply.
Yeah.
The prevailing narrative out there goes like this. If anyone, anywhere, can prompt an AI to create a high-quality, hyper-personalized movie tailored exactly to their specific tastes for, pennies, why would anyone pay a premium monthly subscription for Netflix?
Right.
The market is terrified of a future where content creation basically goes to zero, making entertainment a cheap, ubiquitous commodity.
So the market assumes infinite cheap content destroys Netflix.
Exactly.
But despite this loud, terrifying narrative, the Wall Street analysts who actually cover the stock seem completely unbothered by it.
They do.
There are 50 professional analysts covering Netflix in our data stack. Do you know how many currently have a sell rating on the stock?
0.
0. Not a single sell rating out of 50 analysts.
That's telling.
In fact, 8 rated a strong buy and 29 rated it a buy. The consensus Wall Street price target is $114.15. And with the stock currently sitting around $72.88, that implies a massive 47.5% upside. Even retail traders are looking at this drop as a glaring buying opportunity.
Yeah.
So I have to ask you, are all 50 of these Wall Street analysts completely asleep at the wheel regarding the existential threat of AI? Or is this 40% sell-off just a hysterical market overreaction?
What those analysts see, and what makes this setup so fascinating, is the asymmetric risk and reward.
Okay, asymmetric how?
When evaluating an opportunity, you look for asymmetry, where the potential upside vastly outweighs the downside risk. Let's look at the downside first.
Sure.
The downside risk is mathematically limited right now by that $12.5 billion in free cash flow we talked about.
Because of the buybacks.
Exactly. The buybacks create a sort of synthetic floor under the stock price.
Oh, I see.
Yeah, if the broader market panics about AI and dumps the stock further, Netflix simply takes its massive cash pile and buys up those discounted shares.
Right, they just gobble them up.
And by reducing the total number of shares available on the open market, they artificially increase the value of the remaining shares. The cash flow protects the downside.
Okay, and what about the upside? Like, what is the specific catalyst that forces the broader market to finally wake up and realize the fundamentals are completely divorced from the stock price?
The crucible is coming in mid-July with a Q2 earnings report.
The moment of truth?
That is where the narrative finally meets mathematical reality. The market is waiting for hard confirmation of 2 specific things. First, did they actually hit that expanded 32.6% operating margin?
Right.
And second, is the ad revenue actually pacing toward that $3 billion target?
And if they hit those numbers, what happens mechanically to the stock?
If July rolls around and the earnings confirm that the ad tier monetization is working exactly as guided, it completely destroys the bear thesis.
And then?
And that triggers a very specific financial mechanism called a short covering rally, or, short squeeze.
Oh, short squeeze. Break down exactly how that works for the listener.
Sure. So when investors bet against a stock, when they short it, They are essentially borrowing shares and selling them, hoping the price drops so they can buy them back cheaper later and pocket the difference.
Okay.
But if those July earnings are fantastic and the stock suddenly shoots up, those short sellers are trapped. They have to buy shares on the open market to return the ones they borrowed, no matter how high the price has gone.
Oh, wow. So they're forced to buy.
Exactly. That forced panic buying acts like rocket fuel on the stock price. It forces a rapid mean reversion, driving the stock back up to its fundamental value and proving the core business is highly resilient, regardless of whatever the current AI hype cycle is doing.
So what does this all mean? Let's try to bring this all together for you listening. Based on the mountain of data we've reviewed today, the investment thesis notes give Netflix a definitive 8 out of 10 bullish score.
A very strong rating.
They are an unleveraged cash machine, generating over $12 billion in free cash flow. They're trading at a deeply compressed 4-year low valuation. They have incredibly disciplined management that's aggressively buying back stock rather than burning cash on legacy media acquisitions.
Right.
And they are rapidly scaling a highly lucrative advertising tier that is doubling in size, completely shrugging off the broader market's panic.
I think the ultimate takeaway here is the vital importance of separating stock price emotion from fundamental business reality.
100%.
The stock market, especially in the short term, is a voting machine driven by narrative, fear, and hype.
Yeah.
But in the long term, it is always a weighing machine, driven by actual cash flow, expanding margins, and real earnings. Understanding those mechanics, how to look past the red on a chart and analyze the actual health of the underlying business is just essential for any savvy investor.
The business is not the stock, and the stock is not the business.
Perfectly said.
But I want to leave you with one final thought to ponder, something that builds directly on this massive market fear of artificial intelligence. The market is terrified that AI will make content creation infinitely cheap and abundant. Like, anyone, anywhere can prompt a machine to make a movie.
Right. The fear is infinite supply.
A sea of endless commoditized content.
Exactly.
Right. But let's follow that logic to its natural conclusion. If content truly does become a cheap, infinite commodity, basic economics tells us that all the real value in the entertainment industry will immediately shift away from the creators.
Yeah, it's interesting.
Where does it go? It shifts toward the company that owns the ultimate distribution pipeline. Think about it. If there are 1 billion AI-generated movies flooding the internet tomorrow, how do you find anything worth watching?
You need a curator.
Exactly. You need a trusted platform. With over 325 million screens around the world deeply entrenched in their ecosystem, maybe Netflix isn't a vulnerable legacy media company waiting to be disrupted by an AI generator. Maybe, in a world of infinite noise, they are the unassailable global toll booth for whatever content comes next.